Hello all, hope everyone is doing great. My name is Bishwajit Ghosh and today I'm going to discuss about financial ratio analysis. So let's proceed. What are financial ratios? Financial ratios are numbers that compare different parts of a company's financial statements to see how the company is performing and how healthy it is financially. Analysts, investors, and managers use these ratios to check if the company can pay its debts, make profits, and use its resources efficiently. Ratios also help compare companies of different sizes and track performance over time. Moving over to the first ratio, that is net profit margin, which shows how much profit a company keeps from its sales. It tells you how many cents of profit the company makes for every dollar it earns. The ratio is calculated by dividing net profit by total revenue and then converting it into a percentage. In simpler terms, a higher net profit margin means the company is more efficient at turning sales into profit and is generally more profitable. A lower net profit margin indicates higher costs relative to sales, meaning less profit is earned per dollar of revenue. Next is gross profit margin, which shows how much money a company keeps from its sales after paying for the direct costs of making its products or delivering its services. It tells you how efficiently the company produces what it sells and how much of each dollar of revenue remains before other expenses are paid. The gross profit margin ratio shows the percentage of revenue left after subtracting the cost of goods sold. It measures how efficiently a company produces and sells its products. In simpler terms, a higher gross profit margin means the company keeps more money from each sale to cover other expenses, indicating efficient production or strong pricing. Whereas a low gross profit margin suggests higher production costs or lower pricing, leaving less profit from sales. Next is asset turnover ratio. The asset turnover ratio shows how well a company uses what it owns to make money. It is calculated by dividing sales by the company's total or average assets. In simpler terms, a high asset turnover ratio means the company is using its assets efficiently to produce revenue. A low asset turnover ratio indicates that the company may not be using its assets effectively, generating less sales per dollar of assets. Comparing the ratio to industry averages helps evaluate operational efficiency. Next one is earnings per share, which shows how much profit a company makes for each common share. It tells common shareholders what portion of the company's profit belongs to them. Investors use EPS to judge how well a company is performing, to estimate future earnings, and to understand the value of its shares. A higher EPS means the company is more profitable and has more profit available to share with its shareholders, whereas a lower EPS indicates less profit per share, which may suggest lower profitability or higher costs. Investors often compare EPS over time or with other companies to assess financial performance and growth potential. Next one is payout ratio, or sometimes it is called dividend payout ratio. Shows what part of a company's profit is paid to shareholders at dividends. In simple terms, it tells you the percentage of company's earnings that is shared with investors. In simpler terms, a high payout ratio means the company gives more of its profits to shareholders. This can be attractive for investors seeking regular income, but it may limit funds available for growth. A low payout ratio means the company keeps more profit to reinvest in the business for expansion or debt repayment. Comparing the payout ratio to industry norms or the company's past ratios helps assess its dividend policy and sustainability. Next one is debt to asset ratio. This ratio tells you how much of the company is funded by loans or debt. In simpler terms, a high debt to asset ratio means the company relies more on borrowed money to fund its assets, which can increase financial risk. A low debt to asset ratio means the company uses more of its own funds, equity, to finance assets, indicating lower financial risk. Comparing this risk to industry standards helps evaluate a company's financial stability and risk level. So that's all what I have today. Hope you all found my video informative and liked it. Thank you.